Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City, and I'm here to bring you trading levels in the major market indexes for the upcoming week of June 24th, 2024. We'll take a look at the three major market indexes, the SPY, the triple Qs, the IWM, as well as the bonds as represented by the TLT ETF. Before I get going, the usual disclaimer, Precision Trading Labs, we are neither money managers nor financial advisors. Nothing that I'm presenting here should be construed as investment advice. Everything I'm doing here is for informational and informational and educational purposes only. And in the case of our subscribers, it's helping them on their journey to becoming competent traders. So here we go. Here is the chart of the SPY here. The SPY, of course, is the ETF of the S&P 500. We're looking at a daily chart here. And incidentally, last week was actually a shortened trading week for the June 19th, Juneteenth holiday. So last week there were only 4 trading days. So this vertical line here marks the prior Friday's close. And so here, of course, are the 4 trading days that occurred this week. So we can see price actually hit another all-time high here, and then there was a minor pullback on Friday, and so that's where we closed here at about 544.5 here. If we look below here at this yellow region here, we can see that there was a consolidation for the better part of a week here. And then all of a sudden here, there was a major gap here, and price spiked from here. Within this region here where there was this consolidation, this is where essentially supply and demand were in balance, okay? And then right here, there was an exhaustion of sellers. Okay, no one was willing to sell here anymore. And so price then spiked from here. And what's left in its wake is what we refer to as a demand zone. If we think of the shares that are acquired by buyers as demand, we can then also think of the shares that are sold by willing sellers as supply. And so within this yellow region here, supply and demand are more or less in balance and are trading within this relatively narrow range of 532 to 534.5. So about a 2.5 point range there. And then all of a sudden, no one was willing to sell here anymore. And so essentially buyers had to run up the price chart until they found willing sellers at higher prices. And so what we're looking for is when price returns to this level, since price has not been back here, we anticipate that there is still some residual buying pressure, residual demand that is waiting in this region here. And so when price returns here, this is where we would express a bullish trade. And to express a bullish trade here, one of course could buy the SPY at that level at 534.5 or so. But another way of expressing a bullish trade here would be to buy a call, of course. And then of course, naturally, there are any number of other option strategies where one could express a bullish trade. But essentially, the trigger point for that is a return to this demand zone. Okay, so that's the principle of the foundation of the trades that we set up here. If you look below this video, you will actually see another link. That link is for another video that we did, and it's a slightly deeper dive into the concept of supply and demand. So if you're interested, I would suggest you scope that out and take a look at it. So that's the story with the SPY. Okay, below here there is another demand zone based on a 2-hour chart, and so we can see the demand zone that I was just discussing here. That's a little less than 2% down from current price. Okay, right now we're sitting at 544.5, and you can see, of course, that this demand zone is sitting at roughly at about 534.5. Excuse me, about 10 points below. So this is where we would enter a bullish trade. And then there's another demand zone here based on the 2-hour chart, a few points below here, and that's about 3% below current price. Okay, in the case of the SPY as well as the Qs, I actually don't have a supply zone to show you because we're sitting very close to all-time highs. But when we do get to the Russell 2000 and the IWM, I'll then be able to turn this concept on its head and show you a supply zone there. So that's the So that's the story with the SPY. If we move along to the Qs, of course, the Qs are is the ETF of the Nasdaq 100. Okay, and you can see right here, this is more or less the same looking chart as the SPY. Okay, and more or less the price more or less moved in concert with the other symbol here. You'll notice though that the levels are a little further down than the SPY. On the SPY, we saw there was about 1.5% and 3% down here. Notice that this nearby demand zone is about 3% down on the Qs, and then that other demand zone further down is about 5%. So we have kind of very similar structure, but the distances are different. Consequently, we'll have to look in the coming week and see kind of if there is a pullback, how energetic the pullback is, because what's going to happen is one of these levels is going to hold on one of these symbols, and the question, of course, is which. And so we'll wait to see how price pulls into this zone, and we'll wait to see whether we're actually going to take the trade based on where it hits on the SPY versus where it hits on the Qs. And we'll be looking to smaller time frames to kind of help us refine that assessment. Okay, so we can see that the demand zone on the Qs here is about 3% down from the close, and then the 2-hour demand zone that I showed you on the SPY, in the case of the Qs, that's sitting about 5.5%. Also, before I move on, you notice this little note that I have here on the in this chart here for the XLK. If you look at the XLK, which is the sector ETF of the technology sector, you'll notice that the chart looks very, very much alike in relation to the Qs. And of course, the Qs are heavily tech-centric, and the XLK is the ETF of the tech sector. So it's unsurprising that the XLK chart looks a lot like the Qs. And as a lot of people will say, while the chart is not identical, the two charts rhyme. So that's the XLK kind of rhymes with the triple Qs. Okay, so that's the story with the Qs. If we now move to the IWM, okay, the IWM, of course, is the ETF of the Russell 2000. Okay, and so here's where we closed right here, just around 200. Okay, so right here below, there's this drop-based rally formation here. Okay, and so this represents a demand zone of what I described earlier with the Qs and the SPY. Okay, but now because of the fact that we are not at all-time highs or even 52-week highs for the IWM, this one actually has a supply zone that I can now show you. Right here, notice price came up here in about mid-May. Notice it consolidated there, and then it kind of dropped. It plummeted from this 1 week region of trading up here. Okay, so right here, supply and demand were in balance here. Okay, but in the case of this formation, this represents an exhaustion of buyers. Okay, before on the SPY and the Qs on the levels below, this represented an exhaustion of sellers. Up here, it represents an exhaustion of buyers. Okay, so right here, supply and demand are in balance. Okay, price plummets from that region. So when price returns to that region above, what's left in its wake is what we refer to as a supply zone. Because right here, supply and demand were in balance. When there's that exhaustion of buyers, there is no longer any demand there, but there is only residual supply up there. And so as a result, we call this a supply zone. So when price returns to the supply zone, this would be an area where we would express a bearish trade. And so one, of course, could short the IWM, and of course, the most straightforward, simple option trade to express a bearish trade up here would be to buy a put. Okay, so right here, we closed at around 200, and this supply zone here is sitting at around 208. Okay, so as a matter of distance, that's about that we would require about a 4% rise in the IWM to reach this area of supply, and then this would be an area where we could express a bearish trade. Okay, so in addition to shorting the stock or buying a put, one could also sell a bear call vertical credit spread, and then one could actually collect premium up here, and that would be another way of expressing a bearish trade at the supply zone there. Okay, so that's that's the story with the IWM, and lastly, we'll finish up by looking at the bonds via the TLT ETF. The TLT represents bonds of longer duration of at least 20 years expiration and beyond. Okay, so that would have a 20-year or 30-year. So this does not include the 10-year note. Of course, you know, if one looks at one bond chart versus another, they will oftentimes, of course, rhyme. But this is the TLT. So here's where we closed on the TLT at around 94. And if we look back here now, and we go back here in time a bit, you'll see that right here, at the beginning of March, we had this rally base drop formation. Okay, so right here, there was the consolidation here, price rallied up, consolidated, formed that base, and then notice then the couple of outside gaps and price drops from there. So right here, supply and demand were in balance, and then what was left in its wake, of course, once the exhaustion of buyers occurred, this is where this left in its wake a supply zone. And so when price returns here again, we could express a bearish trade like I described in the Russell 2000 that we just looked at a minute ago. So right here, that supply zone is sitting at approximately 1.8% above current price, sitting at around 95.5. We closed at around 94, so it's got to pop back 1.5 points. But then this would be where we could express a bearish trade. Okay, and so that's a supply zone based on the daily chart. And then if we look below here, you'll notice right here this orange box here. Right here we have a drop base rally formation. Okay, right here, this is more or less a pivot in the daily chart. Excuse me. But if we drop this down to a 2-hour, okay, when we do that, you'll notice right here, then you can see there is a clear base that forms right here. Okay, so now essentially what we have is using the 130-minute chart, which is my version of a 2-hour chart. You'll notice right here these three candles, they consolidate here, and then notice then there is a very bullish sharp move, energetic move up from there. So this is where we would be looking for a pullback here, and we could express a bullish trade. Okay, so again, we close at around 94. This is sitting at around 91 below here, so that requires about a 3-point drop out of here. But if we get that 3-point drop, this is where we would express a bullish trade. And of course, as I said before, one could buy the stock, buy a call, or in the case of trying to collect premium, one could also do a bull put vertical credit spread in order to then collect premium out of this demand zone. But all three of those scenarios, they're all foundation of that is all based on a trade entry at the front line of that demand zone, and in this case, that's at around 91. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs, and I will see you next time.